want to go into true quantitative easing versus the quantitative easing behavior, because there is a difference where it's not fully true quantitative easing. So I think we need to break that down, the difference.
I'd like to know the difference.
So true quantitative easing is net expansion of the Fed balance sheet, which they're doing.
Which is the Treasury bill purchases.
Ongoing asset purchases. And this is the kicker: intent to lower rates and stimulate growth. Bingo. They're saying they're not doing that last piece.
Come on.
They're not.
That's why this report came out.
Well, it's funny because the intent is in person. The word intent. So if it lowers rates and stimulates growth, that's fine.
I know this word, intent.
But the intention is not there. So currently, this QE-like behavior, this is what they're doing. So they're doing liquidity injections into the Fed. Doing liquidity injections that the Fed says are temporary. They're not going to be permanently doing this. It's temporary. They are cutting rates, but it's not quantitative easing because they're not buying assets, creating money, or trying to stimulate the market.
First of all, has the Fed ever said that they've done anything permanent in the history of the Fed?
Yeah.
Is there anything permanent? No, everything is temporary, right? So that's just your go-to word.
So the Fed is saying they're currently protecting the system and not the investor. And that's why it is not quantitative easing. They're not trying to stimulate the economy. They're just trying to keep the systems level.
Jerry, we got to go and do a deep dive here. We have to go and talk about each time they've expanded the balance sheet, the different marketing tactics. Because that's all this is.
Well, and so right now, currently, they're investing in the repo market, which a lot of you have heard about, for the banks. The bank liquidity is an issue, so they're investing there. And then the treasury market. But the treasury market is really the big one because that's the one that's going to fluctuate, influence the rates. And it is a slippery slope between maintaining and stimulating.
Well, I'm telling you guys right now, this is why that report came out. You guys will find that in the show notes. I'm telling you, it's the first time I've seen anybody take a stance where the federal funds rate could be as low as 2. So now, it might not be accurate. I just want to point that out. But I haven't seen anything, and these are guys that know what they're talking about. I haven't seen anything that's been that low. So we're going to dig deep into that later in Q1 to try to figure out, what's the rationale behind this. Again, it might not be accurate, but the point is that there's some really smart people out there saying that these Treasury bill purchases are going to create a big demand for assets. And, we are potentially going to really see an interesting year.
And so the markets, you have to look at how markets respond to things and why they respond this way. And, the reason that the real estate market is picking up, mortgage applications were the highest since 2023, about 3 weeks ago, is because they are looking at what the Fed is doing. And that's what you guys should be looking at as well, because that's what's important. Don't look at what they say, just like a person. Look at what they do, right? So there's a shift away from QT. So they ended QT and they really did do that. And that's, that's done for now. They're accepting higher inflation. Inflation right now is at 3%. Because they're lowering rates at this point, they're accepting that. And that's 50% higher than it was in 2019. And they're preserving the system over purchasing power.
Yeah.
Period.
And I think, guys, we're still going to have a bit of a rocky real estate market in 26. And I think that rents are going to be flat and all that kind of stuff. It's going to be an incredible buying opportunity. I seriously believe that. So, so what would I be focusing on? I would be focusing on REITs, REITs. Now, I'm not suggesting you invest in REITs. Please do your research here. But the commercial real estate market particularly has gotten really, really punched hard in the last couple of years. Cap rates are high, interest rates are high. All the values are down and all that kind of stuff, which is why we had a really good year this year of buying personally, and why we're going to buy next year. So then what will happen is that transforms into the REITs that own the same kinds of properties, right? So it might be something you might want to take a look at this year. Do your research, please. I personally don't buy a lot of REIT stocks, but if I was sitting on the sidelines and not buying the assets myself, I probably would take a look at these.
Yeah, and what you have to understand is inflation is the chosen escape valve here, let's call it, right? Like they either have to let the system crash, which is what everyone thinks that thought that they were going to do. But the reason the Fed is lowering rates, the reason that the Fed is buying treasuries is because they don't want the system to collapse. So they're choosing inflation because you have to choose one or the other. And I think you need to understand that when you make investment decisions, like saving money, putting it in CDs, like all of that is not great for your money because of inflation. And assets rise with inflation. The stock market rises with inflation. Things rise with inflation. So you just have to keep in mind that they're accepting this inflationary time.